What is the science of managing risk? Well, the question often is asked, okay, Colin, so I understand this is my tolerance, but how do we build a portfolio that reflects that? Is it just, for example, diversification? Hi, friends. This is Colin Richards. I'm president and founder of Lord & Richards, and I'm excited on this segment of the Lord & Richards show today to be talking about top questions that people are asking us about retirement. And as we're talking to people every single day, just like you, people are concerned. They're concerned that events out of their control, wars, economic difficulties, high inflation, low inflation, whatever it is, those things are going to mess up your retirement. And that's a legitimate concern. And so what we do at Lord & Richards is we come alongside of you and we help you build a comprehensive financial independence plan so that you can retire without worry and do the amazing things that you want to do with the resources God has entrusted to you. So one of the key questions that we need to answer is this simple question: how much risk should I be taking in my portfolio? And it really isn't just during retirement, but it's leading up to retirement. We understand, of course, that if you're fresh out of high school or college and just getting started, there's a lot of runway ahead of you and you can take a little bit more risk. But you know what? Wasting those early years with excessive risk can also be devastating down the road, because we want to have solid hits in your early years that you can compound on for the rest of your life. And so doing crazy things and losing your money in the first decade of your career is not a strategy. And by the same token, when we're looking at the door of retirement or we've already passed through, we need to understand the importance of mitigating and managing risk. Just ignoring it, just putting our heads in the sand, so to speak, is not a solution, right? It is not an option. And so a simple question that we want to determine is, what is your risk tolerance? We talked about that in our previous episode. So once we determine how much risk you personally can handle, then what we want to do is leave emotion behind and start looking at scientific ways to build, design, manage, and maintain a portfolio, an investment mix that will keep you within the bumpers, so to speak. I used my bowling analogy, right? We want the ball, even if it's bouncing around to the edges, to ultimately land and hit pins. We don't want to be in the gutter. So we got to put up those bumpers. What is the science of managing risk? Well, the question often is asked, okay, Colin, so I understand this is my tolerance, but how do we build a portfolio that reflects that? Is it just, for example, diversification? You know, I remember Peter Lynch's book, One Up on Wall Street, back in the 90s, manager of the Fidelity Magellan Fund, you know, kind of an epically famous fund. He used to call it diversification, okay? I remember somebody said it this way. He says, you know, we don't want to put all our eggs in one basket, so to speak, but rather, if we have a basket that doesn't have any holes in it, that might be a basket worth piling your eggs into, right? So instead of just diversifying, here's a couple of things to remember. Diversification, there's nothing wrong with it, and it's a solid principle of investing, but it will not solve your risk problem. Okay, that is a common flaw, a fatal flaw in thinking that just by diversifying across various sectors, companies, and so forth, you're going to remove risk from your portfolio or a large amount of it. There is a question that every investment advisor, that's fiduciary, has to answer. Is it possible to diversify away market risk? That's on the test you have to take. Is it possible to diversify away market risk? And you know the answer. It is not. You say, well, wait a minute. We're always told to just, spread everything out, put it in a lot of different baskets. Colin, are you telling me that that does no good? Oh, it helps, but it also reduces your returns, right? Because by lacking focus in your portfolio, you reduce your returns and also reduce a little bit of your risk. But here's the problem. Take big market events like 2008, 2009. What happened when the market went down? Well, 14 out of 16 asset classes went down. So that's a problem, right? You can't diversify away market risk. Market risk can take you down. even if you're spread across all kinds of different sectors. Somebody has put it this way: a rising tide raises all ships, but a falling tide does the same as well. Here's another one. People say, well, I've been advised to use dollar cost averaging, just forget about risk and just keep pumping money into my portfolio. Well, although that sounds good, what that really is, it's not a risk strategy. It's just a strategy to smooth out the purchase price of your portfolio. It's a nice thought. And for the broker, it helps keep your money flowing into your brokerage accounts and increasing his commissions. But folks, that is not the answer, okay? There's nothing wrong with having steady, consistent savings, but just trusting dollar cost averaging is not going to get you out of the risk problems that many people are facing. Market timing, of course, is not the answer. Okay, this is one that's universally understood at the professional level, but unfortunately is almost universally ignored at the individual investor level. Someone has wisely said, it's not timing the market, but time in the market that counts. Time in the market. By timing the market, very often you're timing away the biggest moves of the market. I've had to have conversations with clients who forced us to move assets into cash during periods of volatility, only to discover that by doing so, they had already absorbed the full downside of that market. And it's called capitulation. It's something that traders actually look for. When do individual investors give up and go to cash? That usually signals the start that the market's going to go back up. You don't want to do that, right? Because I watch it time and time again. Clients will say, I'm going to go all to cash, right? That's my strategy. And they miss significant moves of the markets. And studies have been done over and over again showing that that is a failed strategy. It really reduces your long-term returns. So it's not timing the market, but time in the market. So that's not really a risk strategy. Well, what about asset allocation, Colin, right? A 60-40 portfolio. I'll have 60% in stock, 40% in bonds. I've asset allocated. Well, that's not the answer either. Just like in 2008, when we saw all these asset classes dropping simultaneously, other than cash. What about 2022, when we saw both stocks and bonds go down at the same time? We've been here before. This is a broken record. Stop saying unprecedented, advisors, because it is precedented. We do have a lot of precedent that says that a 60-40 stock bond portfolio not only is not an answer to risk management, but it is also out of date. It is out of date. By trying to dilute risk in this way, you first of all dilute your returns, and you secondly still expose yourself to the risk that bonds carry. You say, wait a minute, I thought bonds were a safety net. No. In 2022, bonds broadly lost 25% simultaneously with stocks. So there was no place to hide. Bonds are not the answer. Here's a great Warren Buffett quote. I like to quote him. He's very quotable. He says, only when the tide goes out do you find out who's swimming naked. Are you swimming naked? Are you relying on failed, out-of-date strategies, diversification, dollar cost averaging, market timing, and asset allocation to remove risk from your portfolio? If you're doing that, you're setting yourself up for disappointment. Folks, we're going to have a conversation in our next episode about a better strategy to remove risk and continue growing and achieving your financial goals. But in the meantime, I would love to have a conversation with you. My team and I would love to visit with you about how you can secure your financial independence through a simple process we call a financial independence review. It just starts with a simple phone call.